one of the old saying is, even wealthy people fear running out of money. So those are just making sure that we build a plan surrounding that. And essentially, that's where the canoe metaphor comes in. So the canoe and the current. Let's have your essentials paid for with guaranteed income using a canoe. The canoe is what's going to keep you afloat, even when the current has rough tide.
You see this on like a Reddit forum, and it'll say, what's the safest, highest yield investment that I can make? And it's like, those don't go together. Like, you don't get high return in a safe investment. Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm here with Patrick Negado. Patrick is a retirement income strategist and financial consultant with a mission to help people transform from fear to uncertainty to clarity and confidence. He's the author of Canoe in the Current, Rethinking Retirement So You Can Stop Worrying and Start Living. Patrick, I'll stop there because, like I said, I like to let you tell your story. But first, I just want to say thank you. Thanks for being on the show today. Thanks for taking the time to be a part of this with me. I'm very excited to talk to you and get to hear your story. So thanks for being here.
Thank you, Jason. Glad to be here. Glad to meet you. And thanks for that wonderful introduction.
Awesome. Well, let's start with your story. Tell us about your background and how we got here.
Very well. And maybe it's a good way to start as a child, because that kind of inspired me to get to the profession that I'm in. Born in the Philippines, moved here when I was 10 years old when my parents separated. So we went from kind of living a pretty nice upper middle class lifestyle with maids and drivers and private schools to living with a single mother, doing her best to raise a rambunctious teenager in downtown San Francisco, living in inner city schools, right? My vision of America was completely different than what I ended up doing going to school in San Francisco. When growing up, I'm a Gen Xer. So growing up, my vision of American schools were either Fast Times at Ridgemont High or Greece, right? So instead, I went to an inner city school where life could be sometimes dangerous, but for the most part, I stayed out of danger, made some good friends, and it's a good thing we were more into sports than we were into drugs or anything like that. So we managed to survive out of the city. Anyway, so as a Gen Xer, what we're known for really are being latchkey children. I mean, our parents, most of us were raised by single mothers, quite candidly, all my friends growing up with. And we were basically given a key given a key, and you do whatever you need to do and come, as long as you're home by decent hour, you're good. And so we'd play ball all day or cut school all day. And then my mom would at times have to go out of town. So I'd be left at home with $20 to fend for myself. Right. So that was up until about 14 years old. And then we moved to the suburbs where I experienced more of a functional family type where people actually considered taking school seriously. But with that said, what that developed in me is, I guess, a fierce independence. I'm kind of like, I've been on my own, really, for lack of a better term, since I was 17. I was kicked out of the house at 17 years old. Couldn't get along with my stepfather. And so, in essence, really had to try to find my calling in life. And so thankfully, I've run across some pretty good people who mentored me along the way. And I went from, I guess, selling shoes for a living to then trying to do real estate, and then ultimately finding an interest in financial services. And that's basically what I got into. In 1997, I became a financial professional. Again, fiercely independent. I didn't like to listen to the people who taught me. What I like to tell people is the financial professional we work with is generally only as good as a firm they started with, or at least if they've learned to develop out of that, they're essentially heavily influenced by the biases of the firms that you're involved with. And since then, I've gotten into management. Actually, let me even rephrase that. So I struggled for a while. So there was a good 3 years where I was taking second jobs at night, working security. I think I got fired from a security job because I fell asleep on the job, and then I worked swing shifts for the county, putting together divorce, child support paperwork, and then just really just experienced a lot of things until I finally made it. And then even then, we almost kind of didn't make it again. So what I like to tell people is I've quit a few times in this industry, and then I certainly then eventually really just got good at it and learned on my own as far as hiring other coaches to teach me versus learning from a firm, reading a lot of books to get really good at my craft. And then I got into management as well. So in management, I kind of learned what the industry was really like from the inside out. And candidly, I didn't like what I saw. So I've now developed into, let's say, 28 years later, I've developed into the financial advisor that I am today, which is essentially, I'd like to call myself a negative optimist, right? I mean, I'm kind of really cynical when it comes to the industry, and when I deal with my clients, I give them the nitty gritty of what's good, bad, and different about what they're doing and what people have taught them, and I hope to earn their business that way, right? And sometimes they don't want to hear what I have to say, but I think truth is always the best recipe when it comes to um, anything, especially when it comes to finances. So yes, 28 years later, I'm in a position in life where I've released my first book. And thank you for the introduction. It's called The Canoe, the Current. I have a second book that's finished, but it's going to complement this book, and hopefully you'll have me back to promote that book in the future. And I just don't know when I'm going to release it yet because it complements this book, and I kind of want to let this book do its thing before we release it. And I guess looking back 28 years, I'm now looking at a person who I wanted to be in the industry, and along the way, kind of lost my way and found my way back. So, so I think I have a lot of friends in high school, people I knew who peaked in high school. I'm certainly glad I didn't, because I feel like I'm still peaking.
Yeah, yeah. That's yeah. It's. I mean, thanks for sharing all that, Patrick. I mean, it's so much. So many different things I think that we could touch on there too. And I think
Yeah,
as a fellow Gen Xer raised by a single mom, I know exactly kind of what that what that lifestyle looks like. And I think, I mean, frankly, I think it creates a good entrepreneur in a way. You developed there. It's sort of silly to think back, but I mean, there was a lot of development came through angst. I know a lot of the music I listened
totally.
to, a lot of kind of that generation. I think was a lot of that just kind of based on like almost like that was the time when people started to talk about things that were hard. Basically, like before it was our generation before don't talk about it. Like baby boomers don't talk about things that are hard. Gen X we expressed it through music and kind of that rebellion sort of act. There was seemed like maybe a lot of pent up anger in our generation, but I think
Yeah,
now at this level and a lot of us I mean, I'm 50, so the Gen X is we're an older generation. uh it has translated, I think, to those of us that have worked through those things. It translates well to being having success in business, career, whatever it is, family, when things get hard. I think that's and that maybe that's too big of a generalization, but I feel like in a lot of ways that has happened, and I see that in myself and my friends, and also guests that I've had on the podcast. So it's interesting to look at what look back at what generationally what generational influences you might have kind of growing up, but you also had um, the additional influence of being an immigrant. So I'm sure that is an entirely different uh, piece of the puzzle in development over time. But I think where I'm going with this is you mentioned sort of, I guess, having challenges and losing jobs, but also you found things about the industry that you didn't like. Things that didn't feel right to you, and sort of sounds like did something about that. And so I think I'd love to. go in on that a little bit more, like some of those things that maybe you didn't like,
Yeah, sure.
and then how you approach your process and advising clients and all of that, how you've taken that information and kind of flipped it around and used it to your advantage.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Sure. The industry is obviously very competitive, right? And so everybody is always trying to create value when sometimes there is no value. So those were some of the things that in some ways I wanted to make sure I wasn't that person, right? So give you an example. I came up through the life insurance channel initially. I was my first firm was primarily a life insurance firm that I worked with, but they were also doing securities on the side, right? So they're trying to make more of a holistic approach, except we're really promoting life insurance sales, right? And again, when life insurance is your primary tool, then that seems to be the only solution you have for everybody. And I have to say, I probably regret some of the things I advised people to do in the past when perhaps the life insurance policy was not the perfect thing to purchase. They should have invested in something else, but it is what it is. So I've learned from those lessons. And of course, in the life insurance industry, what attracted me to it was its creativity and marketing. At the end of the day, life insurance has different types of policies, cash values, term, and so on and so forth. But the way life insurance cash value type policies were sold, I found it to be quite interesting. In fact, when I first came on board, one of the reasons I got into the industry is I worked for a software company, where the CEO of the company has been on the front page of the Wall Street Journal twice in his life. The first time in the 70s, he sold Malcolm Forbes the largest life insurance policy at that time, right? So he was front page Wall Street Journal. Second time was my last year working for the company when he was promoting a tax strategy so aggressive, the IRS came in and shut it down. So now he didn't go to jail, but they just shut down the strategy, right? But I thought, man, this is fantastic. Tax deductible life insurance, you have tax deferred growth, and then tax free income, right? So those things do not exist. But hey, he got traction on it for about 2 years, made a lot of money, and then the people who bought into his system, I think, eventually all had to shut it down, and whatever policies were sold during that time were eventually the IRS came what they call the clawback of those deductions were probably very painful to the clients, right? And so, of course, I learned from that, and like I said, I was fortunate to have a mentor who says, "Be careful about the firms you work for because they're only interested in really getting you to learn the stuff they want you to learn. At the end of the day, you have to learn stuff on your own and be able to do what's right for your client." And I kind of always fell into that philosophy. I have to do what's best for my client regardless, right? And sometimes if I have to turn business away, I turn business away. My philosophy is that's the best way to have longevity in this business, right, versus trying to take advantage of people. And there are enough people like that who do that. So then a few years doing that, I finally became a little bit successful. I started my own investment advisory firm because I wanted to be fiercely independent, right? Now, the problem with being a registered investment advisor is you don't have a broker dealer you're working with. And again, broker dealers tend to be really in your business. They want to make sure you're not doing anything misleading to the client, so on and so forth. It's really, in some ways, for the best interest of themselves and the best interest of the client. So the issue there is I was a fee-based advisor only. And so I charged a fee for assets under management as well as a planning fee when necessary. But I realized I was missing out on some commission products that offered guarantees I could not, right? But like I said, I've kind of went 180 degrees. I went from being commission-based life insurance and mutual funds and commissionable products and annuities to then being completely independent, just assets under management fees. And I realized learning as I was still learning in the industry, there were some commission products that really did a great job for clients who were looking for certain guarantees. The problem is the industry got kind of dirty because a lot of people sometimes that's all they had. And so that was a solution for everybody. And so I realized I still needed that relationship at some point. And so I got out of that business briefly. I was a little bit turned off by the industry. So I wanted to quit, but then I was called into wholesale. So as a wholesaler, I was working with bank advisors. So I got to see how bank advisors were working with their clients. So these are your typical financial planners or financial advisors in your branches, like Chase or Wells Fargo. They're the ones that the private bank would refer you to. And then, of course, as they get bigger, they go to the wealth management group or whatever it is, the bigger buildings and so on and so forth. So, working with those guys, I was like, these guys don't really know what they're doing. I mean, not all of them. I have to say, not all of them, but there was enough people I worked with that I was just like, okay, they really did not know a lot. They knew enough to be dangerous, but they didn't know anything really beyond what. Because I mean, if I was able to discuss, if you don't know who Benjamin Graham is in this business, then there's a problem, right? So if you're a financial advisor, you don't know who Benjamin Graham is. It's a problem. It's like saying I don't know who Warren Buffett is, right? And so those were just some of the things. And then so the wholesale part really I got to see that in the banks, they want you to do things a certain way. Then of course the life insurance side, they want you to do a certain way. As an RIA, I did things a certain way, but I was limited. Like, as much as I could say I'm totally independent, I really wasn't if I can give you anything that's completely guaranteed. So I was a wholesaler, and then I got into management. So in management, I was a branch manager where my company wanted me to only sell certain products. I tried to train people I recruited to try to get them to be better advisors. No, we just need them to sell our products. They can earn their way to being a better advisor at some point, but for now, we need them to push products. And that really just did not work with my philosophy. And then last but not least, or second to the last thing, is I then became a second manager for a larger firm, meaning the second in line. And when I was primarily training new guys. And so when I would do what I felt was right for the client, head guy would say, well, why don't you have them sell this life insurance policy? So it didn't fit the client, right? Well, we need to sell life insurance in our office. I said, I get it, but it wasn't right for the client, right? And so I realized that's just not going to work for me. So I went back into basically, I would say semi-independent, because I still have a broker-dealer relationship. And I think I need that because some clients are going to want certain guarantees. And the products that offer certain guarantees are offered through commissionable products, right? So I can do both fee-based and commission. So I think that gives me the best of both worlds, without feeling the pressure of of having to push one product or one investment over the other. So that's probably a little too long, but at least you got the gist, I think.
No, I actually appreciate you breaking it down that way, because I one of the things, I'm not a financial advisor. We invest in real estate. I've tried to learn as much as I can myself about a lot of different vehicles, so that just for my own, mine and my family's financial literacy and wellness and all of that. One of the things I think is, and I somewhat learned this, I think, from the podcast, is I have spoken to so many people about so many different potential investment vehicles that there's no way one person can know all of them and how best to manage or structure each, whether that's, insurance or securities or real estate or tax liens or, there's just so many different places that people could invest and be, set themselves up for a good financial future, that it would be hard for one person to know all of those things. And then add in kind of what you just talked about, in that there are some financial advisors that are essentially salespeople. I don't know if that's a class.
No, that's the number one skill you need to have being in financial services. You need to be able to sell, sell the intangible.
And you need to sell that client what your company sells, not what that client needs most. And again, I don't mean to generalize this, and I appreciate you kind of breaking how some of it works, but that's been maybe the experience I've had and witnessed through others, and some of the conversations I've had on the podcast. So what I hope, in a lot of ways, what comes of this conversation in your book and the next book is that people can have resources to learn enough on their own to understand what that person they're talking to is actually advising them on. Like, are they a salesperson that can only tell you about certain products, or are they going to give you a holistic picture of what your financial future could look like? And maybe it's not one person. Like, maybe you talk to that person and you talk to another person who has a different specialty, and you might have to participate in your own diversification of portfolio, because there might not be one person who's such an expert in everything that they could actually help you in all those spaces. So I think that the way that you've broken it down from an insider perspective is I think, to me, and I hope to others, very helpful in terms of kind of describing what you experienced within the industry.
Well, I think one of the things anybody should first define for themselves is what is a financial advisor supposed to do for you, right? I think a lot of people have different impressions or expectations of what a financial advisor is supposed to do. And a lot of times they fall into the trap of, well, they're supposed to give me good returns, right? I mean, I hired my guy so that my investments do well. Well, I have news for you. More often than not, we're not going to beat the S&P 500 index, right? I mean, you can just do index investing all you want and you'll win 100% of the time, right? Or maybe 90% of the time. There are some investments that could do better, but consistently, probably not, right? So what is a financial advisor supposed to do? What is our job? I think our job is to really be more of a psychologist, for lack of a better term. If anything, our job is to provide you with clarity, and provide you with the right strategy, how you articulated it, if you can, because a lot of people can't even articulate what they want, right? So it's a matter of articulating what it is that you want, realistically speaking, because, hey, I want high returns forever, and that's just not realistic. I don't want to pay taxes. That's great. Neither do I, but that's not realistic, right? So let's put that on paper. So my thing is, the main thing, and this has kind of been a theme for the last 25 years of my career. When I first started the RIA years ago, the investment advisory firm, is my main focus is, first and foremost, is to provide you with clarity, right? You need to have clarity of your current picture. And I think what tends to happen is we fall into this trap too, is some clients they don't like to dig that deep. They want to know enough, but it's too painful and too much work to dig deep. So providing clarity is, I think, the main thing. The thing is, once you provide the clarity, you can then create a plan that's going to get you the vision that you want, right? Or at least to get you the destination you want. Now, the road to that destination could be a straight line, but more likely it'll be a zigzag road, right? A road with some bumps here and there. You just, hopefully you don't fall off the cliff or anything like that. So one of the things I've developed over the years, especially when it comes to retirement planning and then ultimately wealth transfer, is creating a retirement vision statement. Most people, when they retire, they have no idea what life is going to be. They think they know what it's going to be. So I've had clients retire and they travel, and quite candidly, I don't know about you, Jason. When I spent 5 days is enough for me at a beach, and I'm done. I want to go home, right? Yeah. And then if I go and the longest trip we've ever taken is about 3 weeks. And that was a European vacation, and then of course visiting family in the Philippines. And after 3 weeks, I want to be home, right? I don't want to, And then golf. I like to play golf, but candidly speaking, it gets boring after a while, right? So how do you really envision your retirement? I've had clients tell me, don't do it because you got to have a reason to put your pants on in the morning, right? And it's really quite boring. And then we've had people who are just so consumed with taking care of grandchildren, and that satisfies them, and that's great for them, right? But the traveling thing is overrated, in my opinion. And so if you can clarify your retirement vision, we can plan around that based on what you're trying to do, right? And the key, of course, is making sure the first thing is first is that you never run out of retirement income. And I think what people do most of the time is they fall into the old traditional mode of thinking. And this is where, like as I said, the things that they teach you that may not necessarily really apply. This is a very common theme. You need to now switch your investment from back to a 60-40 split between equities and bonds. You may have heard of this before, right? Do a 60-40 split and then take 4% bond yield and hopefully some dividends, and don't touch your principal. And let's pray to God it lasts us forever, right? Okay, that's great. That was great in 1992 when interest rates were significantly higher, right? But now and then you're probably dying within 10 or 15 years of retirement. Now you're living another 30 years, and you might actually live another 40 years. I met with a biologist who lives in Taiwan most of the time, but he's from here, and he's a scientist. And he says, we're developing drugs that's going to allow us to live to 120 years old, right? So now you have to think about those things, right? And so those are the things that what most people don't think of is because they just figured I've accumulated enough, and they're not thinking about the what's called a decumulation phase, meaning how are we going to make this income or at least this asset last you for as long as you live, and that's really key. Essentially, because the old saying, when I first got into the business, one of the old saying is even wealthy people fear running out of money, right? So those are just making sure that we build a plan surrounding that, and essentially that's where the canoe metaphor comes in. So the canoe and the current. It's really, let's have your essentials and guaranteed income, your essentials paid for with guaranteed income using a canoe. The canoe is what's going to keep you afloat even when the current has rough tides, right? And so the current is investing in the stock market. We still want to invest in the stock market. We want to continue to grow that because that's going to be the money you're going to spend for vacations, for gifting to your family, whether it's children or grandchildren. And that's also going to help replenish or increase your guaranteed income in your canoe, because whatever rewards we get there, we're going to take some of that and reinvest it in the canoe. And then hopefully you never have to worry about ever running out of money at retirement. And you don't have to think about managing your investments or worrying about it.
Yeah, it's so. I actually really love that analogy, and the two pieces that I guess struck me, the reality and the clarity, right? Like a realistic clarity of what your picture looks like, and I think it's funny. You'll hear people say like, or you feel like you see this on like a Reddit forum, and it'll say, what's the safest, highest yield investment that I can make? And it's like those don't go together. Like you don't get
right.
high return in a safe investment. Like that's just not a thing. You might get lucky. You might get a high return and have no problem associated with it, but like they're directly inversely proportional, where the greater the risk, the greater the potential reward. And so I think like placing that reality in people as you formulate a investment strategy, but then as you said, like that canoe concept of having you're almost, I don't know if you didn't call it fixed income, but like the almost guaranteed things that were going to come, kind of stay the same. That should be your baseline, and then you build for the extras around that. Is that kind of how you're?
Yeah. So one of the things that I criticize the industry is, so you have basically two types, right? You have the investment advisor types who are fee-based only, and then you have the guys who are commission-based and anywhere in between. So investment advisor types, they stay away from the commission guys because they're only just trying to make money off of you, right? Hey, who isn't? I mean, they're trying to make money off of you too, right? But they're just trying to pretend like they're unbiased when there's just bias in everybody else, right? So
you're just doing it a different way.
Yeah, exactly, right? And then again, I can do both. So hey, accuse me of whatever, but you don't. As I always tell people, you don't want your real estate professional to be broke. So they charge you a 6% commission overall, right? And they split it between them too, because you have to pay you're essentially going to have to pay for all his failures as well, right? Or her failures, but she has to stay in the business, right? So that's the price you pay for that. For financial advising, it's either 1% a year for assets under management, or anywhere between 5.5% to 6% on commission products, right? I mean, that's fairly reasonable. But if you're paying a 5.5%, 6% on commission products, you're generally not getting any additional fees on top of that. Although depending on what you're looking for, you might get additional fees. But I always like to tell people is fees are justifiable if you're getting value for it. If you're not getting any value for it, then obviously we have to determine why you're paying those fees. So I say that because the Canoe is going to be funded by essentially three things: Social Security, right, which you're going to get. Hopefully, I'm not sure you and I are going to get it, but most people are still getting it at retiring now.
People retiring now are still getting it at least.
Are still getting it, yeah. They're still getting it, but they have to wait until 67 to maximize it, right? And then by the time you and I do it, it's probably 75. And then the second thing is if you still have pensions, which very few companies provide those anymore, then that's what you get. So what's the third thing? Well, can we get bonds to pay guarantees forever? I don't know. Can it? And then what's the average what bonds pay out? Dividends are not guaranteed either, right? So I say, why not look at annuities, right? And again, the fee-based guys, I'm not going to mention names, but there's a very large financial investment advisory firm who advertises do not buy annuities, right? Then you have some pundits who also say do not buy annuities. It's a bad deal. I'm not sure how bad of a deal it is when you're getting. One example could be as a guaranteed income payout of 6% a year for the rest of your life, right?
There's lots of people that'll be happy with that.
They'll be happy with that. That's better than 4%. That's not even guaranteed because it's based on your principal. But this is your initial principal investment, 6% guaranteed. No matter how your principal investment does, it's always going to be 6% of the initial investment, right? Now, I'm not telling some companies pay as high as 8.5%. But again, those have some strings attached to it, so we have to discuss that. So when we're talking building a Canoe, I don't want to have any biases. I just basically say, listen, if you're looking for guarantees, which for your essentials, you need this so that you don't worry about your other investments. Because at the end of the day, that's really what we want to focus on are your other investments. So don't accuse me of just wanting to sell you an annuity. That's just essentially your baseline investment so that you don't have to worry about what we're going to do on the other side. Now, I am not the smartest guy in the world, so we're not going to have constant growth on your equities and your equity investments, but we will have growth over time, right? And I may not beat the S&P 500, or we will pace the S&P 500, or occasionally we'll beat it. But it doesn't matter anymore because now that you're retired, your main thing is that guaranteed paycheck that pays you for the rest of your life, because that's one of the things you're never going to get again is a guaranteed paycheck, or at least a paycheck from the company you worked for. And there's really just two things you never, ever want to happen once you've retired. Do you know what those are?
I mean, you don't want to run out of money. I know.
Okay, that's number one. Maybe it's three things, right? But I basically like to put was one is this is the symptom of that. You don't want to have to go back to work because work's not going to take you back, right? Now, you may want to go back to work because you want to, not because you have to, right? Then the second thing you don't really want to do is ask your children for money, right? And so if we can give you that Canoe that gives you all the guarantees that pay for all the necessities in life, then you can be comfortably invested 100% in equities. Of course, quality companies, right? Then that way you have money that's going to grow with inflation. And then once you accomplish those things, or at least once you know on paper, because you never have to worry about your essentials, then you can now start planning about what's next after that. How can I then transfer the wealth that I've built onto the next generation, right? And how would I want to do that? But sometimes people get ahead of themselves. I want to make sure I leave something to the kids. Well, let's make sure that you first and foremost don't run out of money, right? And then let's talk about that, right? So it's basically just being a financial coach and getting people to really direct their attention to what they should prioritize if they haven't articulated.
Yeah. And I I completely agree. I mean, you mentioned this earlier that some people don't know. I mean, they just don't know the answer to the question, and so the
Right.
guidance to get them to that answer, so so you can have a plan. It's like, you what when you do a puzzle, right? You have a box of pieces. You
Right.
look at the cover, you look at that box to see what you're trying to build. So it's like you
Right.
need to have that end vision of in mind. So I think it. I mean, I love the approach. I think it makes a ton of sense. I think diversification in I mean, and I am a real estate investor. I like that asset class as well. I would you put that in the canoe? To me, it goes in the canoe, but I don't.
It depends. It really depends, right? So it's funny because so as you, I told you this earlier, the audience doesn't know this. We recently moved to Utah 5 months ago. Our house is being built, so we're currently in a temporary rental. So I shared my book to our landlord, who owns the block that we live in, and his comment was, "Great book, but it doesn't cover real estate. My canoe are all my real estate holdings." I said, "Yeah, that's fantastic, and that can certainly be your canoe, but is income guaranteed, right? Because if you don't have a tenant,
Right.
you
It's
don't have
no,
income,
it's not. Yeah.
right? So that's all I'm saying. Again, you can define your canoe as what you want, but let's be realistic about that conversation. Keep in mind, remember, so I was still living in California during COVID, right? 2020. I don't remember. You were there, so I remember the old saying is you cannot evict your tenant for not paying rent, right? And you cannot force them to pay rent during this time. So again, is that income really guaranteed? So that's all I don't argue. I say, hey, if that's your canoe, then let that be your canoe. But make sure it's leveraged enough that you, if you have tenants not paying here, then you have enough to cover what you need. And I also said, well, you're probably more sophisticated than the average retiree, right? Because the average retiree, they don't have the wealth that you have. So I think, to answer the question, is it depends, because there are rental real estate you can purchase and be part of the canoe, but then you also have real estate investment trusts, which I don't know. You tell me, where would you put that? Would you put that in the canoe, or would you put that in the current? Depends
Yeah.
on what you can
No,
get
and,
out of
and
it.
I
Are,
mean, I
yeah,
would I would put I would put a real estate investment trust in the current, and I think your point is well taken. I think uh, you know particularly these last few years the income generated by real estate has gone down a lot, and
yeah,
so yeah,
yeah,
it's not guaranteed. So I guess that, but that helps me also, and hopefully the listener helps me, like, just from my perspective, helps me hone in on what exactly the canoe, what exactly the canoe contains versus and where to, and it's just a really valuable, I think, just question to ask yourself too, is like, okay, I I I like real estate. I have always liked real estate. It's been a hard asset class over the last few
hmm
years. If I'm not mistaken, I believe uh, the S&P 500 is at an all-time high again. Still,
yes,
continues to go. So it. I mean, I think that there's. I mean, maybe that speaks to the point about diversity and having multiple different assets in your canoe and or
right.
current. I mean, just kind of like looking at it from many different perspectives, and then having someone like yourself to advise and just ask those questions, right? Like, I think you're spot on, and yeah, I mean, real estate investors, we do tend to get like real real defensive of that asset class.
No, but please don't get. I am not arguing the point, right? Here's what I'll. A couple things. I love real estate. I have nothing against investing in real estate, but it does take capital, right? Number one, it does take capital to invest in real estate. So it's not realistic for the average person to invest in real estate. Not that they can't, it's just not as realistic. Whereas you can put away $1,000 a month. Yes, you put away $1,000 a month, you'll become a millionaire before you know it, as long as you stay disciplined, right? And there's also an old saying, where, well, actually, so I say this, and I don't say this. I don't want it. It's not meant to be derogatory, and I hope it doesn't. It doesn't come off as that. I always say rich people own real estate, right? But ultra wealthy people own stocks. Who's the wealthiest man in the world?
You don't think?
Elon Musk.
I mean, is it currently Elon Musk? I think you know, he and what Larry Ellison are swapping back and forth. Yeah.
Right. Yeah. So they're going back and forth. Jeff Bezos kind of catches on here and there too, but they own stock. It's a stock of their own company, but they own stock, right? And how many homes does Elon Musk own? 0. I'm not saying he shouldn't own real estate. I think it's personally, I think he should own real estate. But again, I just say that to make a point. I'm not trying. I'm just saying it's neither good nor bad. It's just, what can you do? So some people get hung up on, well, I just have to buy this property or I have to do this. Why don't you build an investment plan for yourself that's going to make you money? Because we know, okay, last 10 years, S&P 500 did about, just the last 10 years, 225% total returns over the last 10 years. Average is 14.5, right? Nothing wrong with that. And again, we have rental properties, so it's not like I'm against this, right? I'm just saying, if you're the person who wants to invest in real estate, by all means, let's help you get there. But don't neglect the liquidity needs that you're going to have, right? And plan for that, right? And so I think what gets hung up here is you have two people trying to fight when there shouldn't be a fight. They should be working together, right?
Yeah,
So,
that's exactly it. That's exactly it. It shouldn't necessarily be either or. And
right.
your point is exactly right. The barrier to entry is difficult. Whether you're investing actively or passively in real estate, it's still a big chunk of capital to get started. You know, we could go down a whole nother rabbit hole about your primary residence, but still, there's the ability to get into stocks at a much lower entry point is a really good place, I think, for people to start, for sure. But also, like you said, maintaining that liquidity over time. I agree with you. To be clear, I agree with what you're saying. I don't think I was more asking the question to have the discussion, and not be argumentative about it. I think it's you should look at it all. You should look at it all. There's other asset classes we're not even talking about.
Right. And I was going to say, I don't know. So we have a couple properties, right? And I tell you, whenever I get a text message from a tenant, I'm nervous, right? Because it's either going to be something expensive, right? Or an insurance claim, right? It's never, or I might not be able to pay rent this month, or whatever it might be. But I get nervous whenever I get a text from a tenant. So all I'm saying is, you have to think things through, right? It's not just, I got to do this because this is what my dad told me to do, or my plumber told me to do this, or whatever. I mean, there are so many financial advisors out there that even the plumbing business are financial advisors, in some cases. So I say that, of course, in jest, but because, I remember one of the things that I heard once before, my plumber told me to invest in this company. Well, that's great. So, okay. So do you know much about the company? No. Okay. Then, all right.
Right. Yeah. I guess your plumber may be the plumber may be very educated in investing. You don't know, but I do think that's, the point is, you got to do to me, the thing is, you got to do, having a financial advisor or not, you need to know some of it yourself. You need to do enough research and educate yourself so that you can understand what, like asking, and that might just be asking a ton of questions, whatever the case may be. But yeah, having some self responsibility for your financial future. Like you've got to do that. People have to really realize the importance of that piece of the puzzle. In you don't have to know it all yourself, but you have to at least understand what you're being. I mean, I've talked about things on the podcast in the past, like mistakes I've made. I now have a podcast where I talk to people about essentially like financial literacy and things like that. Right. But I've made so many mistakes. A lot of what I know is because I screwed it up, and so it's like you can and like just silly easy stuff that if I had asked two more questions wouldn't have happened. So um, I think that's really my main objective for people to understand. And Patrick, we are getting close to time, so I don't want to keep you all day. I want to try and switch gears here.
Let me just share one quick note on that, right? So this what a financial advisor's job is to see around the corner before you do. So I'll give you a quick example, and if my client watches this, I hope she doesn't take offense to it. It's not meant to be an offense, but she texted me over the weekend, a couple weekends ago, and she says, "Hey, my sister invested in silver. It's doing quite well. Can we look into that?" So I texted her back, sure. And then I also texted her back the 15-year returns of silver. And if you look at the graph, it looked like this, right? So I said, how would you feel if we invested now and you had this big valley in between, right? Silver is the most volatile metal that you can invest in. And so she says, okay, let's talk Monday. And she said, nah, it's probably a bad idea. I said, I'm not saying don't do it. I'm saying just don't do it because somebody else told you to do it. Let's talk about it as it covers everything else around your financial situation. So I just wanted to kind of digress. That our job is to help you focus on what should get you to the point you're trying to get to.
Yeah, yeah, I completely agree. I think that's and finding a financial advisor that recognizes that job, I think is extremely important. So, but let me I want to ask you the questions I get to ask every guest. The first one is just based on the name of the show being Know Your Why. So Patrick, what is your why? You've had I think a fascinating background, and I love your approach to financial advising and really creating that clarity for people. So tell me what drives you now. What's kind of your motivator?
So I think that's to know your why, and I think I have to go back to what I've said earlier. I think when I entered this industry, what I wanted to do was to be rewarded for doing what's best for other people, right? So I was a big fan of Zig Ziglar. I don't know if you know that name or not. Some people have heard of him, others haven't. But basically, the whole idea is you can get anything in life you want as long as you help enough other people get what they want, right? So that's kind of been the mantra, or shall we say, the philosophy I've lived through my whole life. Is I want to add value by doing something good to other people. I don't want to seem cliche-ish with that. I have my, I figured if I do that, I can then be rewarded financially for that. My why essentially is developed into, you know, doing this for the last 28 years. I get more upset with my losses than my wins, right? I mean, I'm more upset about my losses than happy about my wins. So if anything, I really want to help clients help themselves determine what their why and what they're trying to do with their money. Because a lot of times they just go about doing things because that's what they're conditioned to do. They don't know why they're doing what they're doing. So if I can help them understand that, like in the case of retirement planning, helping them create a retirement vision statement, right? So I have a questionnaire for that. It's very emotional. It's tough for some people, but it helps them clarify their vision, what their retirement is. Then, in addition to that, creating a family financial philosophy, a questionnaire to basically help them determine how they ultimately want their money to do for their children and grandchildren, right? Because they're not going to be here forever. So once they're gone, they have a blueprint for how they want their wealth to be managed by their children and grandchildren. Now, it's up to that next generation, but they at least have a family financial constitution or philosophy, if you want to call it that, to then hopefully help grow that wealth versus lose it all, right? So I think that would be my why now, is really getting people into that phase of clarity so they can make confident decisions and have a stable outcome, because that way you're not changing each time, right?
Right, right. Yeah, no, I love it. I love it. Well, Patrick, when people hear this and they want to connect to you, what's the best way?
Again, thank you very much. The book is called The Canoe and the Current. You can also access the ebook on Canoe and Current, as well as Amazon.com for the paperback. You can reach me on LinkedIn or info@canoeandthecurrent.com. I would love to hear from you. Once you've read my book and you want to give me some comments or have a conversation, I love hearing about it, because obviously it's my first book, it's my baby, and I worked hard to get it. And it's simple reading, guys. I did not make this difficult. My editor really helped me in simplifying it because I tend to get technical. And so I have to thank my editor for that. So
That's great. We'll get that in the show notes so people can find you and the book. Patrick, this was great. I really enjoyed the conversation. Thank you so much for being on the show. Thank you for sharing everything you did. I really do like that canoe and current analogy, and I think it makes it simpler. It's not simple. It's a hard thing to establish that financial clarity. But I do think kind of creating that vision for people is really, really useful. So thank you for being here and sharing.
Simple is sometimes less sophisticated, and I want to
folks listening, make sure you connect with Patrick and please like, rate, and review the show so we can continue to get great guests. And as always, thank you for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?